Are you able to see the PowerPoint?
You're live.
Good morning, everyone, and welcome, and thank you, everyone, for attending our first webinar event entitled Sustainable Investing and Building Your Client Relationships. My name is Henry Schilling, and with me is Steve Shepke.
Good morning.
Together, we make up the research and analytical team at Sustainable Research and Analysis, a newly formed group dedicated to providing independent research, analysis, training, and education for financial intermediaries and others interested in sustainable investing. And I should tell you that Steve and I are both huddled in a conference room at our worldwide headquarters at 85 Broad Street. This is a WeWork facility. And to be honest, we're using this technology for the first time. There may be some hiccups and wrinkles along the way. We apologize. But hopefully you're able to hear us, and we're able to go through our presentation and also take your questions at the conclusion of our formal remarks. So our briefing will focus on current trends and developments in sustainable investing, with a focus on mutual funds and exchange-traded funds, or ETFs. Also investor fund flows, performance, as well as investment product offerings. Now, by way of positioning, it's very clear from various analysis, research reports, articles, surveys, and so on, that sustainable investing generally and environmental, social, and governance integration, or ESG integration as it's referred to in particular, has been gaining traction. And the adoption rates have been rising, and in some cases, dramatically. And this is as institutional as well as retail investors increasingly seek to align their investments with positive societal outcomes. Now, this, according to surveys, is especially relevant for millennials as well as women. That said, sustainable investing assets under management, at least when viewed through the prism of retail investors, mutual funds as well as ETFs that are offered to these segments, is still range-bound. This, in our view, may be due to a couple of factors, but I just want to explain that when we say range-bound, we mean that the net cash flows coming into mutual funds and ETFs are still fairly modest. Now, this, in our estimation, may be due to a couple of factors. There is lingering confusion among investors, as well as financial intermediaries and other investment professionals, over the meaning of sustainable investing and over the financial performance implications of sustainable investing. There is also a shortage of product offerings with sufficiently long management and performance track records, and finally, limited disclosure and transparency around what I would call outcomes. Some of these factors may also apply to certain classes of institutional investors. Now, further, structuring investment programs that take sustainability into account and calibrating expectations for interested investors requires the effective delineation of their sustainable investing sensitivity profiles. And this is no easy task, given that each investor has a unique set of sustainability objectives or expectations with regard to social outcomes. So in other words, a one-size-fits-all approach is less likely to work. This morning, I, along with Steve, will address some of these issues by focusing on the following topics. And those topics are, and I'm hoping that you're able to see this in the PowerPoint. I seem to be having a problem moving the PowerPoint presentation along. So what we can certainly do is, if you don't have access to it, we can make that available following the webinar. But the topics that we expect to cover are: one, what is sustainable investing? Second, building client relationships, the challenges and opportunities. Thirdly, sustainable fund sales and performance. And then fourthly, new sustainable fund products, following which we hope to have a Q&A session. With this, I'm going to turn the discussion over to Steve, and I'm going to try to fiddle with the PowerPoint in the meantime.
Again, good morning, everyone. And I would, as Henry mentioned, I will start with speaking to what we call the definition of sustainable investing, and give you some highlights and thoughts we have after having analyzed the multitude of information and literature that addresses this topic. And I think the best way to start is just to, again, reiterate what Henry said earlier. When you ask the question of sustainable investing, our answer is, what is it? And we say it's the process of allocating capital to companies and other entities, such as governments, with the prospects for achieving financial returns, while also attaining a positive societal impacts. And most often these impacts revolve around environmental, social, and governance issues, hence the acronym ESG. I should mention sustainable investing is a broad concept, and ESG investing as a concept. They're not cleanly overlapped, but that's another subject that possibly we can deal with in the questions and answers. So sustainable investing, our assessment has identified two perspectives. One is from the portfolio and asset manager's standpoint of what is sustainable investing, and that we term the technical definition. And the second perspective would be from the financial intermediaries, RIA perspective or standpoint. Let me start with technical definition. Again, this is from the viewpoint of portfolio managers, asset managers. And that is, and first I might mention there are a number of different names for different approaches to technical sustainability management. We've narrowed it down to four. The first is exclusionary, or it might be referred to sometimes as negative screening. This approach has been with us for a while, and I found when I mention sustainable investing, more often than not, it's negative screening or exclusionary comes to mind. And essentially, it's the eliminating of investments in selected industries, sectors, material classes, and geographic areas which are considered to conflict with investors' ESG values. And I would expand that these may not be well defined, they may just be controversial concerns, such as women's rights, and there's a vast number of others. Most often when you look at exclusionary, you'll see, okay, we're gonna back out tobacco, sectors, alcohol, firearms, but there can be many more. Again, I'll mention this is the most common approach from a technical side, as used by portfolio managers and others. The second approach, technical approach, is what we term thematic, and you could speak to that as impact investing. This is when investments are made in a specific area or project. This could be a physical project to effect a defined sustainable result. Now, one thing I'll make a note of, these defined sustainable results must be measurable. Again, they're physical results, and often this involves concepts such as economic development projects, educational programs, or it could be, you could classify green bonds and the structuring of where that financing will go as a thematic form of sustainable investing. So that's the second one approach. The third, and I will say this to begin with, from my standpoint, this can be very complex and actually bring up some, I think, more confusion than the other approaches I'll mention. It's ESG integration. And this is where portfolio management directly incorporates a company's, and I'm going to highlight, relevant and material ESG data and track record in the securities selection and research process to reflect relevant risk and opportunities. And with risk, I'll stress these are, in addition to traditional financial risk, it's ESG related risk. And all you need to do is turn on the news these days and you can see some gross examples of such risk. Now, one thing I should mention with ESG integration process, you look for them to be consistent and systematic. So it's not just a one-shot deal, it's part of the process. And I stress this because some people, they'll come in and some managers, okay, we'll do it for this security or that security. This is where the consistency of approach comes to bear. Now, the fourth and final area that we've identified under technical definitions of sustainable investing goes under the name of shareholder engagement, and some call it asset stewardship. And this is where I think one area that we've all seen, proxy voting falls under this category. And this is largely can be defined as where the portfolio management or asset management company and its representatives work with companies that they're invested in and their company management to effect a behavioral change in their business and business practices. Hence proxy voting, but more directly, you'll see under shareholder engagement, actually sitting down with the company's management, where a portfolio manager will say, look, our investors are interested in this aspect of the environment or that aspect of the environment. Can you, as a company we intend to invest in, and to put it very crudely, start paying attention to that more? And I think there are, the common example, I think, is the Walmart and the gun sales issue that we saw last year. And I think Dick's Sports was also approached by portfolio managers. They said basically, look, we're asking you to stop selling certain armaments and so forth, and it's because our shareholders desire this. And Walmart and Dick's Sports did respond to that. So those are the four technical approaches. Now, one thing I want to mention is that sometimes you will see that these four approaches are blended or used in combination with each other, which from the standpoint of defining these approaches and explaining them, whether it be internally when developing products, conducting due diligence of potential managers, or working with shareholders and your intermediaries working with shareholders at the distribution process, doesn't make it any easier. All right, second, financial intermediaries, their definition of sustainable investment and viewpoint is somewhat different. And I would suggest that their definition is basically the process of evaluating and selecting, whether it be mutual funds, ETFs, and their management approaches. It's the process of making that selection and aligning it with the client's sustainability interest and values. And I'm going to stress that concept of interest and values of shareholders or investors. First of all, from this definition, this process is a distinctive investment decision overlay in the hands of the financial intermediaries and their clients. So portfolio management is running their portfolio one way. Financial intermediaries are given the task of working with their clients and truly making an independent decision. Is this product good for this client based on that client's interest and values? A complicating factor is that there are really no set definitions, best practices, and regulatory guidelines as to what constitutes a sustainable investment or process. So the intermediary is going out and I would bet the first question they're getting from their clients is, well, what exactly is this concept of sustainable investing? And tell me about its limitations and mandates and risks. And unfortunately, those are defined from a regulatory oversight standpoint, can be fairly loosely defined. So that can be an issue, certainly from the financial intermediary standpoint. Secondly, the intermediaries process is weighted heavily on subjective and qualitative considerations when defining the right sustainable investment for a client. It can vary by platform, it can vary by distributor or individual investors and intermediaries, and it varies because it's heavily reliant on intangibles. And sometimes, and these are the intangibles of what are the interest and values of that client. And sometimes there's an emotional tug involved in that, in defining that interest. So it makes it not only a difficult and challenging process for the intermediary, but it's one that they have to tread carefully with because you're dealing very cleanly and directly with the client's their trust, their view of values, and so forth. Now, given that it's certainly a challenge at this level, and I might add, this challenge not only is present for the intermediary at that level, in the trenches, if you will, but it also will extend up to the product development and management of the, whether it be a distributor or a fund company, and eventually back to the asset manager. But it also provides opportunities to build client relationships at a different level. And I think that it puts the intermediary and registered advisor in a position to explore and identify client sustainability issues, their interest and values deeper, and build an added level of relationship with that client, which will tie that client closer to the intermediary. Now, that said, it's important that the interest of and values and desires of clients be put into a realistic perspective. I mean, you can't always, when you're dealing with values and so forth, especially with relation to ESG and sustainable issues, some will not be fulfilled, and there are trade-offs. They should be highlighted. And finally, this is a complex issue, but I think it revolves around what I've seen at the intermediary level. It's always good to manage clients' expectations. Now, this may be related to performance, it may be related to financial risk, whatever. It's especially important when it's related and spoke to with sustainable investing process. And especially as that segment evolves, because as the segment evolves, new products, new approaches are going to develop, and it's the role of the intermediary, or one of the roles and opportunities, to be able to explain to their clients that, oh, yes, there's a new product. This is how it fits with your portfolio's allocation. This is why it may be better than the other product that your clients may already own. So that managing client expectations goes beyond today, but in looking at how the sustainable investing processes and segments will evolve. And with that, I'll pass it on. I think our next topic is on new sustainable products.
Well,
am I wrong?
Actually, I'm pivoting to a discussion around sustainable fund sales and performance.
And I hope I stayed within my schedule.
But before I do that, I would just ask, again, for your indulgence, we are having some technical difficulties, so I can't push the slides forward. As I talk about fund flows and performance, I would have been referring to a number of charts. So you're going to have to put your imaginary caps on for this. But in the meantime, also, if you have any questions that you would like us to address, my suggestion, and this is the best way to get these to us, is to email us at henryschilling@sustainableinvest.com, and this way we'll be able to receive those and respond to them. What I'm going to do now is, as I said, is pivot to fund flows, and that's the fourth agenda items. And the subject is sustainable fund sales and performance, as I said. Now, many of you who operate in this space likely saw the report that was published 2 weeks ago by the Forum for Sustainable and Responsible Investment, otherwise known as US SIF. The report was entitled Report on US Sustainable Responsible Impact Investing Trends 2018. And I'll use, for the remainder of my comments, I'll rely on the nomenclature that's used by US SIF, which is SRI funds, to simplify things and to harmonize the discussion. Now, this 2018 biannual report, based on data collected and analyzed through the beginning of 2018, disclosed that assets linked to sustainable, responsible, and impact investing strategies have reached 12 trillion, up 38% from 8.7 trillion in 2016, and I take that to mean the beginning of 2016. So this is essentially a 2-year time period, and according to SIF, this represents $1 in $4 now out of 46.6 trillion in total assets under professional management in the US that's being invested or sourced to sustainable or SRI strategies. Much of this growth, per the report, is driven by asset managers who now consider ESG criteria across 11.6 trillion in assets, up 44% from 8.1 trillion at the end of 2016. This top line observation is not inconsistent with what can be observed through the lens of mutual funds and ETFs that are tagged as SRI by Morningstar. And again, this would include funds that, as Steve mentioned, cover 4 categories: the exclusionary categories, thematic and impact investing, ESG integration, shareholder, and I would add bondholder engagement and proxy voting. So these are the 4 categories that are encapsulated here. But just before we get there, let's anchor the discussion by looking at the change in assets for all long-term mutual funds and ETFs between the same 2-year interval. These investment products expanded from almost 15 trillion at the end of 2015, equivalent to the US SIF early 2016 start of the analysis, to 19.2 trillion at the end of 2017, or an increase of 66%. And if you had the chart in front of you, this would have been shown in the form of some bar charts on that chart. But at the same time, and this is the interesting point, if we juxtapose this against mutual funds and ETFs that are classified as SRI by Morningstar, you get almost the identical result for rate of growth over the 2-year period, namely an increase from 151 billion at the end of 2015 for SRI funds to 250 billion at the end of 2017, or an increase of 66%. So in a period when SRI assets have been gaining traction and by some accounts growing rapidly, the SRI segment's growth is consistent with the growth in the mutual fund and ETF industry in general, no more and no less. We took our analysis a step further to tease out the components of this growth. And while we couldn't bring this back with precision to early 2016, we examined the factors that contributed to the increase in SRI assets during 2017 and continuing through the end of last month, October 31st of 2018. And what we come up with is that SRI assets increased from 250 billion at the end of 2017 to 302 billion as of the end of last month. And on the basis of the data for the last 22 months, our research estimates that only about 14% of the growth attributed to SRI mutual funds and ETFs represents net new investor cash into the segment. In fact, the largest factor contributing to growth in AUM, or assets under management, is due to the repurposing of existing funds, and that factor accounts for 61% of the growth. Repurposing represents funds that have been in existence for some time, but have formally adopted some form of SRI strategy by actually amending their offering document, usually to the prospectus. And then the remaining 25% of the growth is attributable to market movement. I'm not even taking into account seed money that might have been linked to new product offerings. So the bottom line is that all of this information translates into an 8% growth rate relative to SRI assets at the end of 16 that can be attributed to net new money. Our conclusion based on these numbers as related to mutual fund and ETF flows indicates a more modest embrace of SRI by mutual fund and ETF investors, and this may be linked to the reasons that I identified earlier on in the introductory remarks of my discussion. With that, I'd like to pivot the discussion now to fund performance. As all of you in this space are aware, there has been and continues to be much debate and lots of academic peer-reviewed research on the subject of how sustainable funds perform, some of which takes into account the performance of registered investment vehicles, and that research benefits from the fact that there is a public track record around these funds and audited financial reports, audited financial results rather. Now, if I can generalize and even simplify, the conclusions range from one, these funds tend to underperform due largely to heavy reliance on exclusionary practices. To number two, these funds tend to outperform. And then three, to a view that sustainable and responsible investors experience fund performance results that are similar to non-SRI funds, and that on average, SRI investing does no harm relative to unconstrained conventional investing. Now, for index tracking funds and ETFs, the ability to evaluate results and reach conclusions is really much less challenging. Once you accept the concept of the underlying index, and that's something that you have to understand and accept, you are largely, but not to overstate it, not entirely focused on tracking error. That's really a primary driver in the decision. But it's much more complicated when it comes to actively managed funds for two principal reasons. One, strategies and performance track records are limited. And number two, definitions around sustainable investing have been expanding and shifting. And there is still no universally accepted set of definitions around these, either at the aggregate level or with regard to the component parts, especially around ES and G. In fact, many of the performance studies in the past relied heavily on the track record of funds that employed value-based exclusionary strategies. So setting aside such funds and focusing more specifically on funds that largely, if not entirely, employ ESG integration strategies with some limited exclusions, it's hard to understand why, all other things being equal, actively managed funds operating in this way would perform any worse or better than conventional actively managed funds. And perhaps over time, I would argue even better. Now, to test this hypothesis and to have an objective way of analyzing results going forward, we created two benchmarks of similarly managed funds that we have been tracking for the last 2 years with respect to one of these indexes, and for 1 year with regard to the second, and we've observed mixed results to date. Now, that said, keep in mind that the investment time horizons for these are still quite short, and we are also constrained by the limitations of some of the data sets that we've been working with.
I just wanted to add something to your analysis, Henry. Henry's speaking about gross performance. When you look at it from the standpoint of an alpha, for instance, and one integrates ESG-related risk, that may give a very, very different perspective. Yes, the gross performance compares nicely, but from an alpha standpoint, that will normalize, and very possibly for funds that do not take into consideration environmentally or social or governance risk, much different results will occur.
Yes, thanks, Steve. So I mentioned two benchmarks that we've created and have been tracking. And the first benchmark is one that we call Sustainable Large Cap Equity Fund Index, or the Sustained Large Cap Equity Fund Index. This is an index consisting of the 10 largest actively managed large cap US equity-oriented mutual funds, all with assets in excess of $50 million, that compare their performance against the S&P 500 formally, and that largely employ an ESG integration strategy that may be combined with some limited exclusions, and in some cases, an emphasis on shareholder engagement and proxy voting. A 3-year track record is not yet available, as the index only goes back to 12/31 of 2016. So we're just looking at a 1-year time horizon. And for the 1 year through the end of October, the index itself is up 5% versus the S&P 500, which is up 7.35%. So this sustained index is lagging the S&P 500 by 235 basis points, or 2.35%. When you examine the underlying funds in the index, 2 of the 10 funds actually outperform the S&P 500, while the rest, or 80%, underperform. So far, these results trail an equivalent universe of similarly managed conventional funds based on the data published by S&P SPIVA, which shows that 64% of large cap equity funds underperformed their benchmark in a 1-year time period. A different result, a more positive one, I might add, is observed when we look at fixed income funds. In this segment, we didn't have a sufficient number of similarly managed fixed income funds of the type that I mentioned that we culled out in the equity universe. So instead, we have been formally tracking since December of 2017 the performance of 5 investment-grade intermediate bond funds that employ those SRI strategies that I mentioned earlier. We refer to this benchmark as the Sustainable Investment Grade Intermediate Term Indicator, and the indicator has been outperforming the Bloomberg Barclays US Aggregate Bond Index, which is the index of choice for these funds, for the past 12 months. At the same time, 3 of the 5 funds, or 60%, have outperformed the Bloomberg Barclays benchmark. And this is a better outcome than an equivalent conventional peer group per S&P SPIVA, where only 48% of the funds outperformed their benchmark over the 1-year time interval. Again, keep in mind that the investment time horizons for these is still quite short, but we will continue to track these results and report on them going forward. I'm now going to quickly pivot to new fund launches or sustainable fund products launched in 2018. By way of explanation, these remarks are going to be focused strictly on new launches, including additional share classes, and not on the repurposing of existing fund products. And what I would say is that overall, in the first 10 months of the year, we saw a total of 59 mutual funds, including share classes, come to market, and as well as ETFs, with total assets of $1.2 billion expressed in October 31 dollars. The lion's share of these were mutual funds, accounting for 69%, 828 million, and ETFs, of which there were 16 and 335 million. And the key observations that we would make is that there have been some new firms that have entered the space, firms like Impact and Amplify, for example, on the ETF side, and Old Westbury, which is managed by Bessemer Investment Management on the mutual fund side. We're seeing expansion of fund offerings to fit into allocation platforms, especially with ESG ETFs. So, for example, BlackRock launched the iShares ESG US Aggregate Bond ETF, which complements its existing ESG income ETFs and equity ETFs, and thereby allowing platforms to construct and offer a fully diversified ESG portfolio using a consistent ESG methodology. In addition, we've seen a number of thematic funds, including funds linked to affinity groups. And lastly, I would be remiss if I didn't mention short and ultra short duration funds. These were launched by Calvert and Hartford in the form of ETFs, and DWS, the former Deutsche Bank, actually came into market with a new entrant. This one is in fact a repurposed fund, but it was unique in that it is an institutionally only oriented money market ESG fund.
Well, before we go into the Q&A, I just want to tell the group that Sustainable Research and Analysis is available to work with you, work with your intermediaries, your distribution staff, your product planning staff, and your management staff. And I'd include in that due diligence groups on sales and client-specific solutions, and I will put in parentheses, helping develop sales strategies and pitches. Secondly, we conduct customized training and education at all levels. And this could include if you have a large sales force or if you have a small group of specialists. And again, I'll pinpoint the due diligence staff. Not a small issue with sustainable investing. It's going to be a new area of review. And finally, we will and we do assist in manager oversight and selection. All of these areas, we rely heavily on our independent and proprietary research at the industry level, product level, and so forth. So feel free to give us a ring, and we'll be happy to discuss how we can help. Now, how do you want to deal with Q&A? Do we have some extra time? I know we have a technical issue here.
We have about 10 minutes. We do have one question so far, and I'm going to check to see if we have any additional questions. One of the questions relates to the volatility of the benchmarks that I made reference to in my remarks. Firstly, I would reiterate that the time horizon is short, so we do really need the benefit of a longer time interval in order to evaluate this most effectively. But so far, based on results for a shorter 12-month period, we do not see any material variation in the volatility of these benchmarks relative to their the corresponding, in the case of the equity, large cap equity fund, the S&P 500, and in the case of the sustained bond fund indicator, the Bloomberg Barclays aggregate bond index. So far the volatility profiles are in alignment with each other. We do have another question about the players in the SRI space today, and the profile of these players. And what I would say first and foremost is that there are about 170 or so companies that have products in the space, and the space is again referred to as mutual funds and ETFs. But having said that, the industry is highly concentrated. So if you look at the top 10 firms that offer products in this space, those firms account for 79% of the assets the SRI assets under management. The largest, these firms include organizations like American Funds, Parnassus, Guidestone, Calvert, American Century, Pax World, and so on. Interestingly enough, when you look at the strategies that these firms offer, the strategies are dominated by exclusions. So what I mean by that is the largest of the firms that operate in this space is American Funds. And American Funds only has one entrant in this space, and that's the Washington Mutual Fund. It accounts for 1/3 of the assets within the segment, and it employs a strict alcohol, tobacco exclusion strategy. American Century Investments is another large player in the space. Its assets account for 4.2% of the total. And it likewise, for many of the funds, but not all, employs an exclusionary strategy. So exclusions within this space, even though the profile of the top 10, or even if you move it to the top 20 firms, which account for almost 85% of the assets, are still largely, well, the segment is beginning to change because we're seeing new players like JP Morgan and Morgan Stanley coming into this sphere. But the lion's share of the assets and the strategies that are being employed still are dominated by exclusions, and in particular, alcohol and tobacco.
I'd like to add to that. One of the things that Henry and I spoke or looked at yesterday when we were reviewing this, and I'll be very quick because I know our time is limited, but as I mentioned, there are these 4 technical definitions. And one of my thoughts was, well, which of these in 5 years or in the long term will end up dominating the sustainable investment fund world? And after noodling on this a bit, Henry and I felt that it might fall into, and this is the projection, into the ESG integration, but not as a separate fund type or category, but as a part of the commonly and reviewed metrics or that are used by portfolio managers. It will become commonplace across all their funds. And the distinction of being an ESG fund will still exist but it will become a given that when you do your financial analysis, ESG-related factors and their associated risks and implications for return will be one common screen. And that means from our standpoint as a category, yes, it will be there, but it will become more common and a normal part of doing the analysis at the portfolio management level. And I'll finish with that. And again, if anybody wishes to speak to us on this, we're available.
So I'm just looking to see to echo Steve's comments. I share the view that ESG integration is going to dominate the landscape eventually. There'll always be a place for values-based investment practices, and that may continue to remain a bit of a niche product, I think. I think thematic investing and impact investing is likely to grow and expand. The same can be said for shareholder slash bond engagement and advocacy and proxy voting. I think that will also become a more prominent component of the overarching strategy. But by and large, the systematic and consistent incorporation of environmental, social governance risks, where these are relevant and material to the assessment of whether it's value or whether it's creditworthiness, we think is likely to be adopted and employed firm-wide, not with respect to any particular individual product offerings, but actually firm-wide as part of the investment process. And a good reason for that, and I think a dominant reason, is that there's widespread acceptance of the notion that these are effective in identifying and potentially through the action that an investment management company takes, mitigate risks, and at the same time take advantage of opportunities over time. But for that to happen, some of the impediments that are associated with ESG integration need to be addressed. And the key one is information and quality of information. Not only in terms of information that is viewed material and relevant, but also information that covers, in some instances, a sufficiently long time horizon, as would be the case with environmental risks, where the emerging risks may be 25 to 30 years out, and the available information today makes it very difficult to make cash flow projections so far out into the future so that they can be used in discounted cash flow models to calculate values on a present-day basis. And for that reason, even though some of these factors may be taken into account today in analysis, they have a limited impact on the overall outcome or the result of the conclusion. So I think we're coming up against our 11 o'clock deadline. It was a pleasure to do this. I do apologize for the technical difficulties. Should you wish to receive a copy of the slide deck, please be sure to send an email to henryschilling@sustainableinvest.com. We'd be happy to send out the complete deck and engage with you in any follow-on questions that you may have about any of these issues. So we appreciate your time. Thank you very much. and look forward to engaging with you, hopefully with better technology in the future.
And have a wonderful holiday.
A Thanksgiving
Everyone.
holiday. Yes, thanks again.